Today we're going to talk about how to become wealthy through debt and expenses. Welcome to my channel, Costa Living, where we help you become financially independent and teach you the stuff that they should have taught you in school but never did. My goal for all of you guys is to become financially independent, to where you have the choice to do what you want in life and not have money be an obstacle for you. I love sharing my information with you guys. You know, I don't like to talk too much about my personal finances. I don't want to come across as, arrogant, conceited. That's not the way I am. I don't consider myself wealthy, but when you look up the numbers do. So, I'm in the top 2%, and I don't say that to be arrogant, but I say that to give you perspective. Look, if you guys are going to learn how to fly an airplane, you're not going to talk to your local grocer on how to fly an airplane or the guy next door, unless you happen to live next to a pilot. But, so if you're going to find out on how to become wealthy and how to become financially independent, you need to talk and listen to people that are financially independent and wealthy. And I'm not saying that I have all the answers. I'm not saying that I'm one of the top guys out there, because I'm not. But I have an answer, and I have my goals and ideas of how to get there. And I highly encourage you to listen to a lot of people. I'm just one pilot. There's lots of pilots out there. Listen to multiples, see which one's going to have the best path for you. There's a lot of different things that you can do to get there. So to kind of keep going a little bit more with this analogy, go, well, what kind of pilot are you? I'm what you guess would call kind of like the Southwest pilot. I'm the pilot of the working class. Like, I got here, I didn't have six-figure jobs. At the time, I didn't have a college education. You don't need all that to become financially independent. You just need knowledge, and that's what I'm here to share with you. Look, you go out to my backyard. I got 3 barbecues on my patio. I make my own wine. I butchered my own animals. Not that I do that now, but I have. So just kind of let you know a little bit about me. I live on 5 acres. It's not, I'm out in the country. I'm not kind of the city guy. Like I said, there's lots of pilots out there. You go find the pilot that has the right direction and guidance for you. For right now, let's fasten your seatbelts, put your trays in the upright position, and let's board this financial plane to your independence. Okay, guys, so one of my goals is to get you to kind of change your thinking a little bit. If most people are telling you that debt is bad and that expenses are bad, well, we want to get you to start thinking more like the 2%, like the wealthy, to start thinking things a little bit differently and doing things a little bit differently. And if you get your mindset around that, you'll start changing some of the things that you do, and hopefully help with that progression to go in that direction. So I'm going to ask you a favor, if you can, and just help me triple D this video. We want to define this video by smashing that like button. It just helps the YouTube algorithm, lets people know that this is good content and they should watch it. And then, of course, help me develop my channel by subscribing down below. All you got to do is just hit that little subscribe button, hit the bell notification. You'll be notified of new videos that come out. And then most importantly, help me deliver this message by just sharing it with a friend of yours or someone who you think might benefit from this information. Best of all, this doesn't cost you anything. It's free. And that is a double D on your triple D. Thanks a lot. So most people would probably tell you, if you want to become poor, you do 2 main things. You rack up a lot of debt and you incur a bunch of expenses. But we want you to think like the 2% and act like the 2%, to where you can take the debt and expenses and become wealthy from it. So what's the difference between debt and expenses that make you poor and debt and expenses that make you wealthy? The difference is good debt versus bad debt. So what makes up the difference between good debt and bad debt? Well, let me define what I think good debt and bad debt is for you. Definition of good debt and bad debt is good debt is debt that is going to create income for you, that is going to create appreciation for you. It's things that will help build your wealth. And bad debt is the exact opposite. It's debt that is going to cost you. It's going to be an expense on you. It's going to drain your assets. And so we really kind of want to look at that. So what is, just some examples of good debt and bad debt. Obviously a car. A car is bad debt. It's going to cost you every month. And it's also debt that you have against an asset, being your car, that's going to depreciate. You buy a brand new car, you drive it off the lot, it starts losing value from day one. So that is an example of bad debt. Credit cards. If you go out and charge credit cards, that's bad debt. You're paying interest on that. That's for something that is you either no longer have, you ate it, whatever it is. It's bad debt. It's not generating anything for you. Good debt would be, for example, your house. You buy your house, you are getting a place to live, you've locked in your mortgage, so you've locked in your rent, it's not going up, and you also have something that's appreciating in value, it's going up in value, and you're also getting pay downs. So your house could be considered good debt. And most importantly, investment real estate is good debt. Now this is debt that not only are you getting the appreciation and you're getting the pay down, you're actually getting somebody else to pay the debt for you. To me, that's the best debt of all. So that's the kind of debt that we're talking about, is how do I now acquire more real estate debt for investment property? And what does that look like? And then, the other thing that we're going to cover are expenses. How can expenses actually make me wealthy? And we'll kind of cover that as well. But for now, it's for, the good debt. What we're going to do is we're going to show out the numbers of what it is to actually acquire a property, what that numbers look like, how that debt can actually work in your favor, and some of the benefits of having that debt. And one of the other things too is when we talk about expenses is, when you have a debt, say a mortgage, you're going to have expenses with that. And so kind of debt and expenses kind of go hand in hand. When you're making your mortgage payment, that's an expense with that debt. And then you have that debt of the asset. So the asset being your rental property, that asset is actually going to create income for you. And so when you have income, that's what's going to make it a good debt, is you're buying something that's creating assets. It's creating income for you. It will help offset some of your other expenses that come with owning rental property. So some of your other expenses that you're just going to have with rental property, and that's just as simple as what it is. I mean, you're going to have vacancies, you're going to have repairs, you're going to have maintenance, you're going to have taxes, you're going to have insurance. These are just part of expenses of owning real estate. And hopefully you'll have enough income to offset those expenses. But we're going to show you how some of those expenses actually will help you in life with just even your regular W-2 job as well. So guys, in this video too, this is just all for educational, informational purposes. Obviously, before you spend any money, before you report anything on your taxes, please check with a professional, an accountant, or whoever you deem necessary to talk to give you the proper information for you, so you don't get in trouble here. Okay, so here are the numbers that I have. Again, I started to go over and explain how I came up with all these numbers. It takes some time and it's overwhelming, and it turned out to be almost an hour. So I'm just kind of summarize it for you here, and you can see where you're at. So essentially what we're doing is we're picking up debt. So we're picking up debt both in the terms of real estate debt. And again, as we determined earlier, real estate debt is good debt. It creates income for you, specifically with investment property. So I put these numbers together, and not to be overwhelmed, we're going to just kind of go through it real quick here. So I figured kind of two different scenarios. So one is somebody that is already in their home. They bought a home kind of in the last couple years maybe. And again, guys, I know you're going to look at these numbers and go, well, I can't buy a home for $300,000. This is the average home across the United States. The average home across the United States is $286,000. So yes, there's areas that are much more expensive. There's also areas that are a lot less. You can see this in some of my other videos that I posted. So I'm doing this because these are the average homes. So if somebody bought a home for $250,000, I'm assuming a $250,000 loan. So there's a couple ways to look at this. You can look at it as if they paid $300,000 and they put $50,000 down, or you could say, you know, it's a $260,000 home and they put $10,000 down. It really doesn't matter. And at that point, what they've done is, because of what's happened over the last couple years, they have appreciation in their home. The home value has gone up. So even though they have a loan for $250,000, the value is $300,000. Now, if somebody has just bought a home recently, there's usually not enough equity to justify a refinance. You know, if this was somebody that actually, you know, bought the house for $300,000 and put 20% down, and got a loan for $250,000, and it's gone up in value even more, then it might justify, you know, refinancing. But for simplicity purposes, we didn't do this. So again, we are becoming wealthy by creating debt. So if we only have about $50,000 in equity, how do we tap into this equity? One of the best products out there to do this is what's called a HELOC, which is just a terminology used in the industry, and it stands for a home equity line of credit. Now, there's several nice things about a home equity line of credit. One is they're very inexpensive to get. Check with your bank, your credit union, whatever you're with. Ask about their HELOC programs. A lot of times they're free if you have an account there. They might be $100, you know, like an annual fee of $100. And especially when you're talking low dollar amounts, usually if it's under $100,000, it's relatively quick to get. It's not full documentation, and it's pretty simple. The nice thing about a HELOC is it's a nice safety net, and it's a line of credit. It's not an actual loan. So with the line of credit, you don't actually have to start paying on it until you actually use it, which is nice. Another nice thing is it's usually the first 5 years or 10 years is what's called your draw period. And so during your draw period, all you're paying is interest. It's an interest-only payment, so you're not have to pay the principal back, which means you're making the absolute lowest payment that you can. Now, you can pay principal if you want, but you don't have to. And probably the downside with a HELOC is that it tends to be an adjustable rate. But it is an adjustable rate based on the current rates. So, you know, over the last, 5 to 8 years, the rates have been so low, it's worked out for people. Now, I wouldn't recommend having long-term debt on here. You're not going to put a whole mortgage on a HELOC, just because of that unknown that it can go up down the road. But this is great for emergency, short-term type of stuff. So what we're going to do is we're going to go out and get a HELOC. You're going to tap into the equity, and usually they can do 80% no problem. A lot of times they can go to 90%, and some places it'll even go to 100%. So it just depends on your bank of where you're going. So what I did is I figured this at 90%. So at 90% of 300 is 270. You already got a loan for 250, which really means your HELOC, you got about $20,000 available to you. So again, how do we use debt in our favor? So we got a HELOC that's freeing up $20,000. Now we can use this money for whatever we want. We want to go on a trip. I don't recommend. That's bad debt. But anyway, that's what this is for. So the idea is we're going to go from a home and go buy a duplex. Go buy an investment property. So that investment property can be a duplex, a triplex, a fourplex, whatever you want to do. And then just to kind of finish through with these numbers, I mean, these are typical rental numbers. And so, what we did is we took a $300,000 home. We said the rent is going to be about $2,000. Again, guys, I understand in some areas your rent could be higher. Some areas your rent could be lower. And then for taxes, I just use as a rule of thumb of 1.2. Again, some areas are going to be higher. Some areas are going to be lower. I used 10% for the insurance. And then miscellaneous. Now, typically when you're doing rental property and to figure out the expenses with your rental property, there's a huge long list. I mean, there's vacancy factors, there's management, there's CapEx, there's repairs, maintenance, which is part of CapEx. So there's just a lot of stuff listed. So rather than make this super long and put all that stuff in there, I just threw everything under miscellaneous just to give you an idea. And again, guys, rule of thumb, 35% of your income would go back into your property. So even if your property is paid for, you're still going to have 35% of your income going back into your property just because of taxes, insurance, expenses, miscellaneous stuff. Obviously, this is kind of, it's just a rule of thumb. Relatively, if you're in an area where rents are really high, but the prices are cheap, it's going to be a little bit different than if you're in, say, the Bay Area and you got a $2 million piece of property that rents for $5,000. The repairs are going to be a lot more expensive. But anyway, just kind of wanted to go through this here. And so when we're all said and done with the home, we're looking at about $232 of cash flow. So now flip this over to the duplex. Duplex, what we did is we figured this to go into an owner-occupy situation. So if you go into an owner-occupy, again, if you don't have a home yet, make your first home the duplex, triplex, whatever, because you get owner-occupy rates. It's classified almost the same as a home. Maybe instead of 3.25, you're paying 3.5, which is what we have up here. So the interest rate might be a little bit higher, but you have income that's going to offset, so it's easier to qualify. Chances are, if you're going to qualify for a 300 home, you're going to qualify for a 400,000 duplex because you got the income from the other side to offset it. So what we did is we either took, you have a duplex, you have no home and your first home is going to be a duplex and you've saved up the down payment of 3%, which is $12,000, or you used your HELOC and you're accessing $12,000 to now have the down payment for the duplex. And again, the duplex might even be the same size of the home as far, this might be a 3-bedroom, 2-bath, and your duplex might be a 3-bedroom, 2-bath. But you're going to get a little bit less rent for the duplex versus a home. So instead of $2,000 for the unit, you might get $1,800 a unit. And since it's a duplex, meaning 2 sides, you're going to get $3,600. So we're making less money on the duplex, but overall, you're actually benefiting. And so again, because we're dealing with the higher price, the taxes are higher, the insurance is higher, your expenses are higher, and of course your mortgage is quite a bit higher as well, because now you're at $400,000. And I figured the loan at $400,000 because if you're only putting 3% down, that's $12,000. You're going to have closing costs and fees, and a lot of that stuff you can finance into your loan. So the net, you might end up with like a $395,000 loan, but a lot of it's going to be eaten up by your expenses. So I just threw $400,000 in there to be conservative. It will actually be a little bit less, so the numbers will be a little bit better. But this is just to give you an idea. So when you're said and done, you're going to have a cash flow of about $820. So I threw that in there, the 232 versus the 820. Now, what this is over here, this is just to give you an idea of if all you did in life was just buy a home and a duplex as far as your investment property, where would you be? How would you be able to retire? What's that going to look like in 30 years? If you're 20 and you're at 50 and you're ready to retire, if you're at 30 and at 60 you're ready to retire, even if you buy them at 40 and you're now at 70, what's the impact of this going to have? Well, there's a couple things that come into play. One is the value of the home itself. You're going to get appreciation. So that appreciation, now obviously right now we have just crazy appreciation. You're at, as my other video shows you for the housing market, we're at 12 to 18% in most areas. Even the worst areas in the country are at 2%. So, of course, this is all depending on your submarkets. I understand there's going to be some submarkets that are negative. Obviously, we wouldn't recommend buying rental property there. But on average, you're looking at about a 6% appreciation rate on property. And so this just takes the $400,000 and appreciate it out over 6%. This is what the value would be in 10 years for the home and the duplex. In 20 years, the home versus the duplex. And in 30 years, the home versus the duplex. And then also what we did is we took the pay down, so the pay down of the loan. So you started with the 250 loan, in 2 years it's down to 191, down to 111, and at 30 years it's finally paid off. Same thing with the duplex. So that's what these numbers are, just so if you see them, you can pause the video, kind of go over them, digest them, and see where they are. If you guys have any questions, drop down in the comments down below, and I will get back to you. Again, and then for rent, your rents are going to go up. For this scenario, I just put 3%, which is going to be the same as what I'm using for inflation. So your rents, the net effect of rents, they're never going to go up, which to me is not true. They're just going to keep up with inflation, but I use that for conservative purposes. And then your expenses are going to continue to go up as well at 3%. Again, just to keep up with inflation. So these are the numbers spread out over 10, 20, 30 years and where you're at. And same thing with the expenses, 10, 20, 30 years. And of course, the loan itself is going to be paid off in year 30. And the other thing that I wanted to bring to your guys' attention when we ran these numbers the first time, this is your cash flow by buying the home and the duplex. You're at 232 plus 820. You got about $1,000 a month coming in. But remember, we borrowed $12,000 from your line of credit. Well, you have $1,000 a month cash flow. So essentially, you're using debt of $12,000 to buy your duplex, and you're taking your cash flow and paying off the HELOC debt. Once this is paid off, this is now cash flow again. You can keep it in reserves. You can use it to live off of, do what you want. My suggestion would be to keep it in reserves and use it to buy your next property. Basically, in another year, you're going to have another $12,000 saved up and go duplicate the process. So that's up here is how do you use your debt to increase your assets. So when we take the appreciation at the end of 30 years, your house is paid off, there's no more loans. Here's the value at that time in 30 years. This is the suggested value of those two properties in 30 years. They'll be worth about $4.2 million based on a 6% appreciation. Again, your rents at 3% are going to go up. Your expenses at 3% are going to go up. And again, these are just with inflation, so these are going to be really a net zero effect, which to me is super conservative. And then what I did is, you can't get caught up on these numbers here because these are numbers for 30 years down the road. So just like you're seeing now, inflation is going to happen. So when inflation happens, the value of these aren't what they're going to be worth 30 years from now. So what I did is I brought these back down to today's numbers. So when you bring these back down to today's numbers, what is my 4.2 million? If I had this in today's dollars, what would this be worth? Well, 4.2 million in today's dollars would be worth 1.7. So that's basically taking out the 6% minus the 3%. So it's really only a 3% appreciation instead of the 6% in 30 years. And then for your income, same thing. The income pretty much cancels each other out. And so that's why when you see this is in today's dollars, you see 2620, essentially all you're doing is you're taking the mortgage plus your cash flow, because in 30 years you're no longer going to have the mortgage. And so when the mortgage is paid off, that's going to increase your cash flow. So 1800 plus 820 is 2620. So that's kind of where that's coming in. There's really no net effect. But essentially what this would mean is in 30 years, based on today's dollars, you would have a cash flow of essentially $4,000 a month, and you would have $1.7 million in assets. So, guys, this is how debt, by just buying two pieces of property, can make you a millionaire based on today's dollars and give you a monthly income of $4,000. There's a lot of you out there that if your house was paid for, you could live off of $4,000 a month and have assets of $1.7 million. And again, there's more benefits and more features that we can show you how to tap into this $1.7 million and even take you to the next level, all tax-free. So, if you haven't subscribed yet, click that subscribe button down below. It doesn't cost you anything, and we try to give you some great content. But let's get into the expenses. Go ahead, hit the subscribe button, hit the bell so you get notified. Okay, so this is debt. How is debt going to get you to become wealthy? And wealthy is the $1.7 million and $4,000 in income. So the next thing that we're going to do, I took the annual cash flow here. So we just took the cash flow, times it by 12, and here we are at the annual cash flow, just to take you to the next level. So what we're looking at now is expenses. How do we make money and how do we become wealthy out of expenses? So this annual cash flow here, now remember, this cash flow accounts for our taxes, insurance, our miscellaneous expenses. This accounts for everything that we actually had to pay out for the house. And so we're looking at the rent that we got coming in minus all of our expenses. This is what I'm left with at the end of the year. So this goes into your pocket. This is actually what you're making. You're making $12,000 a year from day one on this property. But what's the effect of our actual taxes? What are we paying taxes on? Again, check with your accountant and all that. I'm not an accountant. But this is, you now have rental property. You are essentially a business. You are running a business and you have income and you have expenses. So how can I get these expenses to work for me? So even though you put this in your pocket, you actually have to report the actual income. How much money did you bring in? Well, we didn't bring in this. This is how much you made. What you have is you have your rent of $2,000 times 12 is $24,000. You have your rental income of $3,600, which is $43,200. Now, originally you're owner occupying this. So half of this is really not going to be income. This is going to be off. But the idea is that, you live here for a year and now you buy another one or you buy your primary residence. Again, I was just doing this for example purposes. So if you live here for a year and then you move into your dream home or whatever, and those numbers aren't even on here, but if you move into a different home, we wanted to show what the income would be and what the net effect of having a rental duplex would be. If you're living here, these numbers are going to be less, but at the same time, we want to use them for example purposes. So the $3,600 in rent times your 12 is actually going to be your annual income of $43,200. So on paper, this is what you're reporting as income. But remember, you are a business. And you don't need a business, you're not doing business taxes and all this. When you guys are starting out, this is just going to be on your normal tax return. You'll just have a form that you fill out and you'll put all these expenses on there and it'll come off. It'll just be one page in your tax return. But this is your annual income. Well, now you get to write off your expenses. So for your expenses, we're going to take your taxes. You're going to write off your taxes. You're going to write off your insurance. And then all your miscellaneous expenses that you're going to have, you're going to write all those off. Now, the other thing is because this is an investment property, you're going to write off your interest. And so your interest, now, as you guys know, when you get a mortgage and a loan, you're paying a lot more interest the first year than you are on your 30th year. So this number is going to change a little bit. But I just did this for simplicity reasons. I did the first 5 years. So this is the amount of interest that you will pay on your first 5 years. And again, this number will slowly start to go down and you'll actually be paying off more of your loan. But for the first 5 years, I just took an average. So this is your first 5 years worth of interest and what that average turns out to be. Again, your first years will be a little bit higher. Your 5 will be a little bit lower. So now that we have your annual income, you've taken off your taxes, insurance, expenses, what's your interest, just this number, not this number, taking off your average interest. And so the total on this, so now that I had $24,000, I'm now down to $8,700. And 43, I'm down to $18,200. Now, this is the golden ticket for real estate. This is why real estate is so good. Now, most of these expenses, you've actually had these expenses. You had to pay taxes, you had to pay insurance, you had miscellaneous expenses. The difference is your tenants paid all of this. So unlike your primary home that you live in, where you have to go out and earn a wage to pay this, you are now using other people's money. You are using your tenants to go out and get a job and get a wage and make these payments for you. So this here is the golden ticket, is depreciation. So just like any business, when you buy assets for your business, whether it be a piece of equipment or a printer or vehicles, machinery, when you buy that asset, you get to depreciate it out. Well, the same thing goes for real estate. The government says that you can depreciate the improvements on the property. And so what the improvements are, if you look at your taxes, your tax statement for your property, your tax statement is broken into two different categories. You have the land, and so there's a land value, and there's also an improvement value. And that improvement value is the buildings. Any buildings that are on your property are improvements. Now this varies from state to state, region to region, is what percentage that they use. Obviously, if you're in the Bay Area, the land prices are very high and the improvements are a little bit less. And if you're in other places, the improvements are very high and very less. So when you have $1 million piece of property, how much of that is land and how much of that is building? So for this purposes, for a $300,000 piece of property, most of it's going to be in improvements because you have to build the house. The cost of building the house is what it is. So I just use 75%. Now, why this is important is because you can't depreciate land. So whatever the land value is, that is what it is. But you can only depreciate the improvements. And so I took 75% of the value, which was the $300,000, and this is the 75%. Now, the government says that you can depreciate that out over 27 and a half years. So you take the improvements and you divide it by 27 and a half years. And this is what you pay for it, not what the value is now. So if when you paid $400,000, we're going to take 75% of $400,000, which is the $300,000, and we're now depreciating that out over the next 27 and a half years. So these numbers here, this $8,000 and $10,000, this is on paper. This didn't cost you anything. You're not spending this money. This is your business depreciation that you're taking on your property. So now that we have our income of $8,000 and $18,000, we are now taking off our depreciation. So once we take off our depreciation, we're left with the amount of income that we actually have to pay taxes on. And just to show you, so you're actually only paying taxes on $7,700. Remember, you put $12,000 in your pocket. So you put $12,000 in your pocket, you're only paying taxes on $7,000. Now this is only part of the expenses because you guys have a business. So there's a lot of optional expenses. I say optional because this is up to you guys how much you want to do. Again, check with your accountant. But you're going to have travel expenses back and forth to the property. You're going to have to show it. You're going to have to go fix things. You're going to go back and forth. So you have travel expenses with the property. You are now having, you list your property online. You're going to have internet services. So now some of the things as an individual, when you don't own rental property, you have to pay for all these things yourself. But now you can have your business pay for these things. So you have the internet is now being paid for by your business. You now have your cell phone. You have your tenants calling you and you are making appointments. Your cell phone can now be paid for by your business. You're going to have a website. You're going to have a car, office supplies, printers, ink, all this kind of stuff. And this kind of just goes on and on how much you want to check with your accountant. But all of these expenses that would normally have been paid by yourself when you don't have a property, it can now be paid for by your business. So this adds up to where now you have all these expenses up. One property that's just a home, you're actually going to end up negative. And with the other one, So when it's all said and done, you're now down to a negative $500. So what this means, this is expenses. Again, how do you get wealthy from expenses? One, you change your mindset and you start changing your personal expenses to your business expenses. This is why everybody should have some type of business. And you putting $12,000 in your pocket, and now you actually are paying taxes on a negative $530. So what does that mean? Now when you go out and work a W-2 job and you're making money, you can take this 531 off your W-2. You see the importance of this? This is how the rich become wealthy. This is how you get to the next level. So again, this is just one duplex, one home, $1.7 million in net assets, $4,000 in income, and $500 write-off on your taxes. Imagine if you do this 10 times. You would be making $120,000 in cash flow. $5,000 in additional write-offs to offset any other income that you would have. And over $10 million in assets. Almost $20 million. Well, it has $17 million in assets. So this is how you become wealthy with debt and expenses. Hopefully you like this video. Smash that like button. Subscribe to my channel. It helps me out. It doesn't cost you anything. It's one thing you could kind of give back to me. I don't sell anything on my channel. And most importantly, share this with somebody. It kind of helps the YouTube algorithm. Lets people know that my videos are worth watching. And I appreciate it. Hey guys, my goal is to make like shorter videos for you that are a little bit easier to consume, that aren't great big long hour-long educational videos. It just, as I start to explain more and more and more, they tend to get longer and longer. And I apologize for that, but hopefully you guys that are here, you're here to actually learn, and you want to learn the concepts and the ideas and how the numbers work, not just what the numbers are. So this video, I started to do this video with actually explaining the numbers, how I came up with the numbers, what they are. And, I was into this video already for an hour. And I just thought that was going to be too long. So we're just going to summarize the numbers for you. If you want to learn more about it, maybe drop some comments down below. And if we get, a lot of likes, then maybe we'll release the video on, actually how the numbers and where they come from and what we can do about that. Okay, guys. Well, so hopefully you learned a lot and you just kind of changed your mindset a little bit of how you look at expenses, how you look at debt, and how they can actually work in your benefit and work in your favor. And just kind of understanding how debt and expenses play a part in your financial independence and financial future. Well, that's the